Welcome you all into this training. My name is Olakunle Babalola. Um, for those of you who were in the last class, we would look at introduction to forex trading, trading online, the benefit you get from trading online. We also look at the base currency and the code currency in a currency pair. Look at forex majors and crosses. Okay, and also went ahead to explain the economic analysis that you are trading the news, you listen to news, sudden news or breaking news. There are economic calendar where they display the previous value or the previous data, forecast, and actual. So wherever the actual is, you look at it, the value, if it's better or greater than forecast. It's good for the currency pair. Definitely, that currency pair we appreciate. But in terms of employment, we expect that unemployment should unemployment should decrease or employment should increase. So whatever value that is being forecasted for unemployment, so the actual has to be less. So if the actual is less than the forecast, then that currency pair we appreciate. Okay, so in this class, that's just quickly a recap. In this class, now what we're going to do, we look at Canadian currency. You know, Canada is one of the largest oil exporters in the entire world. The reason being that when crude oil loses its value, the Canadian dollar falls as well. Okay, and when energy information is being published and there's a worse than expected oil report, and it triggered the sell-off of oil assets, Canada dollar and oil prices dip to go down, go down. But in this case, whenever the price of um, crude oil is rising, just check it. Canada versus JPY, we buy. This currency pair we appreciate. Canadian dollar versus JPY we appreciate. Okay, but if um, the Canadian dollar depreciate in value, then this currency pair Canadian dollar versus JPY will be bearish. It will sell. Okay, so which means I'm going to sell the currency pair. All right. So that's what it means. So the Canadian dollar has to do with the has relationship with crude oil prices. Okay, when it's rising, it's appreciating. The price is appreciating. Canadian dollar to appreciate. Okay, and the opposite is the US dollar. If the US dollar is appreciating, the Canadian dollar what will appreciate except if you are trading against it. Okay, because they are both dollars. So if you are trading US dollar versus Canadian dollar, and if the crude oil prices is rising, Canadian dollar, that pair USD Canadian dollar will sell. Okay, and in this case, Canadian dollar versus JPY, it will sell. You sell this pair when the oil price is dipped. Okay. Now let's look at gold. Wow. When inflation is high, investors prefer to save their money and buy gold. Okay. So you watch out for economy of nations and especially the United States of America, when their inflation is high and the Fed statement is dovish, it's not hawkish in nature, then it means that is the Fed is not ready to bring down inflation or to combat inflation. Definitely gold is going to buy. You're going to buy, it's going to appreciate, going to skyrocket, going to jump up. Okay, and trading gold is very important because gold appreciates a lot, and the volatility is always high. Okay, the movement is always fast in trading gold. Okay, as high volume, so gold is It's a special commodity to trade in Forex, and it is safe haven for gold. Inflation is safe haven for gold. When there's high inflation, you what? You buy the currency pair. You buy gold versus US dollar. Okay? So, but if inflation is going down, you what? You sell gold. Okay? Now, let's look at the booming US economy. With traders' appetite for risk, they sell gold, making its price, the gold's price to what? To go down. Now, look at this analysis. US economy is good, means a strong dollar. Then what? You sell gold. You sell gold. US economy good, means US dollar appreciate. You sell gold. US economy is bad, it means a weak US dollar, then you what? You buy gold. Whenever Japanese economy is stronger than US economy, what do? You sell gold. No, you buy gold. You buy gold. You buy gold. You don't sell gold, you buy gold. You know, Japanese economy is stronger than the US dollar, what? You buy gold, you don't sell gold. It's an error. I will need to edit it. You what? You buy gold. You buy gold. Now, let's look at the non-farm payrolls or NFP, excluding farming industry. Now, better than expected labor data, gold price will fall, that is smaller than forecasted. So if the value, the actual is what? Is better than the forecast, that is greater than the forecast. It means you need to what? You need to what? To gold price will fall. You need to what? You sell gold. That's what it means. For instance, if the forecast was 50 and the forecast was 50 and the actual is 45, it means the is better than is the actual is better than expected. So what? You sell gold. Now, in the non-farm payrolls data, when the actual is worse than expected, gold price will rise. That is what you buy gold. This is what it implies. If the non-farm payroll says the forecast is 20,000, and you now have 25,000, it means gold price will rise. That's how it works. Then gold price rise with rising crude oil prices and vice versa. Also look at the US Fed interest hike which controls inflation, thereby making gold price to fall. So when gold price is falling, it means you are selling gold. So you pay attention to Fed interest hike. Okay, each time the US Fed interest rate is being hiked, okay, what you need to do if you are trading gold, just watch it. Gold is going to what? Going to fall. The price of gold is going to fall on the sell. All right, so US dollar usually benefit from pandemic, especially you need to watch. You need to watch it. Okay. Normally, when there's pandemic, okay, gold will rise. The price of gold will rise. But now you need to now focus your attention on the US economy. If that pandemic now favors the US economy, just know that US gold is going to what? And gold is going to sell. Gold versus US dollar is going to sell. Sell is going to go down. The price will keep falling because the economy of the whole world will crash. So, but if the US economy is rising, maybe US is economy is benefiting from it, gold is going to fall. But if US economy is not benefiting from it, then gold is going to what? The price of gold is going to appreciate, it's going to rise. Okay, so another idea is this: when the US dollar indices, okay, so this is what I do. I open the indices, I check to confirm. When the US dollar indices is rising, just know that gold is going to sell. It's not going to buy. So the price will depreciate, it will not appreciate. Now this is the logic because King Dollar, we call it King Dollar. You know, most of the transactions globally is being executed using United States dollar. So that is why gold is the US dollar is very important and strong. Now let's look at the Euro USD. When inflation is high, investors prefer to save their money and buy gold. Yeah, we said that earlier. Booming Euro economy, they buy. When the Euro economy is booming, is good, then you need to buy this pair. Okay, making its price to go up. The price will go up, so you need to buy. So you check the economic calendar, and the actual is greater than forecast for euro. Then if you are trading this pair, you need to buy this pair. Okay. Now let's look at the non-farm payroll as well for the unemployment for eurozone. You look at the eurozone, the same thing. If the value, okay, if the value, okay, of the eurozone now, if it's poor, the data is poor, you need to set this pair. What I mean is this, that if the forecast, the actual is, the value of the actual is greater in terms of number now than the forecast, then you need to sell this pair. What I mean by, if the unemployment is the forecast, you forecasted, let's say 5,000, and the actual is now 7,000 or even 6,000, which means there are more unemployment. So you need to sell this pair. But if it's less, okay, this is how you know. You go to the site, whatever site you are using to check the economic calendar, the actual economic calendar. Most sites will use color, okay, use conventional color to help you to easily at a glance to know if the actual is good or bad. So most times, if it's bad, it will be in red. If it's good, it will be in green. Okay, then also you see the impact of volatility. Okay, if the volatility is going to be high, it's going to give you the result is going to give you high impact. Some sites will use red to indicate high impact, and then maybe brown and yellow. Brown for medium impact, then yellow for low impact. Some will use uh, double color, double indication, maybe double dots, triple dot to show high impact volatility. Then second dot will show medium impact, and just a single dot will imply low impact. So whenever you are trading the news, you are using fundamental analysis to trade, you have to be careful. Most time it's usually highly volatile. It moves fast. It's going up, moves go. It's coming down, move fast. So you need very careful when you're trading it. All right. And then also, if the US dollar, that is indices, is rising, this pair will this pair will fall. Just watch it. It's going to fall. It's not going to buy. It's not going to buy. It's going to sell. Then also, if the USD JPY is buying, okay, this pair will sell, and vice versa. Okay. So I'm going to stop here. In this video, in the next video, we continue. All right. So I'm just going to discuss what we call a lot size. A lot size is just some unit of the asset you trade, be it a currency pair, a stock, or an index. Now, for Forex, one standard lot size is $100,000 base currency unit. Then a mini lot size is 10,000 units, and a micro lot size is $1,000 unit. Then for stock, one standard lot size is $100, indices, one standard lot size is $10. Now, for instance, now you're trading Forex and you want to trade one standard lot size of Euro USD, you will need up to 100,000 US dollar. So you now ask me, oh, where am I going to get $100,000 from? That's the essence of leverage. So in the next video, I'm going to explain to you what we mean by in detail leverage. Okay, so and this is what you're going to need: $100,000 to trade one standard lot size. So, but most traders use a micro lot account. A micro lot account. Okay, so with $1,000 unit you trade, and yet you still make use of the leverage. Okay, so you don't really need to have the $1,000 to start trading. Okay, so I'm gonna stop here. In the next video, we're gonna look at leverage, margin, swap, cashback, rollover, and then also show you how to enter trade. Okay, then then the next subsequent videos, then we'll go into technical analysis. All right, thank you. I believe you enjoyed this video. If you enjoyed this video, I would like you to click the add button and subscribe to this video channel. Then you turn off the notification so that you'll be the first to receive the alert on whenever we upload next video. Okay, also go through the comment section as well. You see our telegram group, and join the telegram group where we discuss more on forex, and also we send forex signals, okay, to our members, our telegram members. Okay, so I'll encourage you to, if you don't have a broker or you don't have a good broker, register with FBS. There's a link at the comment section. You see the link. Okay,